So we're going to focus today on one of the more important elements of a strong, comprehensive financial plan, and that is investment allocation and developing a strong investment strategy to help fulfill your overall financial plan and assure that it's consistent with all of your planning objectives. One of the more critical components of an investment allocation strategy is risk assessment and understanding what your risk tolerance is based on your time frames and your needs and when you'll be using the money that you're investing. We can establish a risk level that's appropriate. Individuals have different time frames and different needs for the money they're investing, and that's critical to the levels of risk they take with their investments. They also may have their own internal emotional levels of risk tolerance that they can accept. So it's critical to assess someone's individual risk needs and build a investment allocation that's consistent with those needs. Generally, what's important when you're considering risk is assessing the time frame associated with when you need the money that you're saving. If you have a 10-year or more period of time before you would even need to utilize the money that you're saving, you can start to consider taking much greater risk and using a more aggressive portfolio approach than if you said you're saving money to buy a new house in 2 years. You would likely, in general, be much more conservative with the nature of the investment strategy that you apply. When you're trying to strike a balance about the level of risk you should be taking, the focus, again, is really on the time frame and when you need the money, because you can gain significant benefits from a more aggressive and higher level risk portfolio if it's a long-term strategy, because the volatility of the markets or the ups and downs of the markets won't have as great of an impact on you if you have a long-term horizon before you would need the money that you're saving. Very important to a sound investment allocation strategy is diversification and making sure that you're exposing your investment portfolio to as many sectors of the market as possible and assuring that it's well-rounded and well-diversified. So you can use real estate, you can use oil and commodities, or you can use precious metals or foreign investments. It really depends a lot upon, back to that risk tolerance level that you're willing to expose yourself to, the time frame that you have for the investments, and the amount of money that you have to invest. And oftentimes even the options that you have, whether you are investing inside a 401k or an IRA, you may be limited to particular options depending upon all of those different options that you may have available to you. You want to consider all the different possible sectors and components of the market that you could invest in. When we're constructing an investment portfolio for you, and when we work with our clients to do that, we're focusing on all of those critical aspects of diversification and time horizon and when they're going to need the money and different risk levels. And we try to apply to those strategies the best selection of funds to that strategy and make sure that the selections are consistent, and focusing on long-term performance of the funds that we're selecting, the expenses associated with those funds, but again, utilizing a range of funds to make sure that the diversification objectives are met. A very important element to a strong investment strategy is to try to maintain a routine and frequent scheduling of investing into whatever the diversified portfolio that you've constructed. The more often you're making investments into that portfolio, the less subject to the risk of the volatility of the markets that you are. Termed dollar cost averaging oftentimes, but the idea is that you're investing on a regular basis into that strategy that you've created so that you can maintain an ongoing injection of funds into that diversified portfolio that you've created. So the schedule investing concept is really the alternative to timing the market. Folks would like to look at their investment portfolio as buy low and sell high, but because that's a very difficult strategy to incorporate into a long-term financial plan or long-term investment portfolio strategy, the ongoing schedule investing and dollar cost averaging helps someone to assure that they're less impacted by the volatility of the market. One of the very important aspects of an overall investment portfolio is how much does it cost for me to have that portfolio. There are different components of expenses related to investment strategies and investment portfolios, and they include how much it costs for the advisor to assist and guide you through the investment process, but also internally in the investments that are included in your portfolio, there are expenses associated with those investments. Oftentimes they're considered mutual fund expenses or the expense of an exchange traded fund. So what's very important is we're taking a look at what the expenses will be for that client to make those investments and to have that investment portfolio. An investment portfolio strategy is going to take into consideration when you need the money that's you're saving that or that you're allocating into that investment strategy. And so the liquidity of cash inside that investment portfolio is important to assure that if you're going to need cash at a certain time period or on a certain regular basis, that the investment portfolio is constructed to meet those needs and those liquidity requirements. So you may need a certain component or portion of your portfolio to be invested very conservatively in liquid type funds so that you know when you need a particular amount of money that it's going to be available to you. If your cash flow and liquidity needs are very long term and the horizon of time for when those are going to be needed are 10 years or more out, then liquidity and being conservative with components of the portfolio become less critical than they would if you had current cash flow and liquidity needs. One of the very important considerations when constructing an investment portfolio is what the tax implications may be from that investment allocation strategy. Some of the good things about an investment portfolio is they produce income, and that's always the objective. You want your portfolio to grow and to produce income for you, but depending on the type of investment you're utilizing, that income may create tax liabilities. So it's important to consider the tax implications of an investment portfolio when you're constructing the allocations so that not only can you be achieving your long-term investment objectives, but you can assure that from a tax liability perspective, you're optimizing the portfolio and its allocations as it relates to the tax liabilities that may result from the growth of that portfolio. But oftentimes it's not so much that you have a desire to produce income, but it might be the lack of awareness of the types of investment you're utilizing to achieve a diversified investment portfolio and not recognizing that those investments are going to produce current income and current tax liabilities. So while the tax implications may oftentimes be associated with personalized objectives or needs, they could also be simply due to not being aware of the tax implications that are going to arise out of a particular strategy. So we try to make sure that you're looking at those and considering those different tax implications when we're constructing a portfolio so that they're part of the consideration that we're making in deciding on which assets to incorporate into a diversified portfolio. Not unlike the scheduled investing strategy that helps to assure that you're dollar cost averaging and that over time you're building a portfolio that's less subject to market volatility. Rebalancing strategies have a similar importance in that they help to assure that as markets shift and as certain sectors of the market are successful and maybe other sectors of the market are trending less successful, that you kind of revisit the allocation of your portfolio and possibly rebalance it a bit to assure that the original objectives that you had about different components of the market that you want to be participating in and maybe the different percentages of assets that you want your portfolio to be constructed of are still consistent with those original plans. It may be that the growth sector of the stock market trended up significantly while the value sector, so to speak, had a less productive year. And so at the end of that year, you may want to revise the balances in those two sectors of your portfolio to be more in line with what your original objectives were, so that over the long haul, you're remaining consistent with your objectives. And you also may need to rebalance because your life changed or your objectives changed or those time horizons that you had originally changed. So you may need to rebalance from a more aggressive portfolio to a less aggressive portfolio because you're closer to retirement or because you might need a particular element of money for college or for some other purpose, and that might require rebalancing because your objectives changed. Monitoring and reviewing your plan at least once a year is critical. It's important to assess whether you have particular life changes or objectives that changed throughout the year, and if that's the case, you may need to revisit your plan. But on an ongoing basis, and as things are going along fairly normally in life, you should at least sit down and review your financial situation and your investment portfolio once a year at the very least. So what's important to us with the overall life planning process, but as it pertains specifically to investment portfolios, is that we're understanding individual client needs so that we know what your needs are, what your objectives are, what you're trying to achieve with your investment portfolio, so that we could mold a plan around those objectives. No portfolio is generic in the sense that it can apply to just anybody. It really needs to be constructed around individualized personal needs of the person that you're developing the plan for. So with all the different elements of a soundly constructed portfolio, risk assessment, diversification, scheduled investing, all those key components, it's very critical that you consider your particular personal needs and objectives, and that a plan be built around those needs and objectives. Some of the things that will surprise individuals that they may not have considered would be, for example, the tax implications. Oftentimes, a portfolio will have maybe a kind of an average year, maybe be a flat year, but the investor will find out at the end of the year that they still had income in their portfolio. There were dividends or capital gain distributions in their mutual funds, and so while their investment portfolio didn't change very much, they get this big tax bill because their mutual funds produced a bunch of income. And so it's important to know going in what the potential tax implications of the income that your investment portfolio might produce will be, and that will help to build the tax strategies around which you construct your portfolio. Another area that could surprise individuals or could sneak up on them is saving inside a retirement portfolio, but needing the money in that portfolio before retirement. It's critical that the types of investment accounts that you establish are very consistent with what the goals and objectives for that money may be. So if you're setting aside money to buy a home in a few years or for college for your children in 5 or 6 years, generally you wouldn't be utilizing a long-term retirement plan to invest and save those monies in, because if you need those monies sooner than your retirement, it could become difficult to pull those monies out, or very costly to pull those monies out, and that could be a gotcha or a surprise for someone who's been saving, but maybe saving in the wrong investment vehicle for their particular purpose. So another very critical element to a strong and comprehensive financial and life plan is retirement planning. In the next video, we're going to discuss the specifics of a strong retirement plan and the key elements that you should be considering when you're constructing your retirement plan.